Hi everyone, good morning and welcome back to the channel. This is another episode of the bonds discussion. Previously we have discussed about the basics of bonds, what bonds actually represent, how do we uh, how do we differentiate between different type of bonds, how they are classified, basic bond terminologies and the basic definition of bond. And now we are going to start with how does a bond is being priced or how does the market prices a bond. And good morning, everyone. My name is Deepak Bisht. And before we start, let me just ask you a very simple question. If somebody promises you to give back, let's assume that somebody promises you to give back $100, 100 or $1,000 today or after 5 years. What would you prefer, today or after 5 years? And most of you would say, why am I even asking this question? And why I'm asking you is this because money today can be used for investments to spend on your needs. You can save that money, you can use it for emergencies. But if you were to receive money after 5 years, that's of no use today. So we will talk about today. And that's why when whensoever we see that there are cash flows in future, we discount them back to today. We actually discount them back. So this is inwards. So this is today, and that's future. So these are future cash flows. These arrows are representing future cash flows. So that's discounting. This is discounting. And if from today we are talking about future cash flows, so that's actually compounding. So understand the difference between compounding and discounting. All right. So this is actually a simple idea. This is a very simple idea, but this is actually the basics of finance. And unless until you understand the discounting and the compounding impacts or the concept of compounding and discounting, you will not be able to understand how the money flows, how the cash flows actually work uh, for today, why people uh, value things, and why people actually have different opinions about things, the pricing of things, how do they price them, how do they value them. And this is actually a very simple idea. Just like I said, that money today is more valuable than the money in the future, and this is the foundation of bond pricing also. So okay, and so today we will help you understand what bond pricing really means in this episode, and why bond prices move up and down, what yield is, uh, why interest rates matter, why risk exists in bond, and finally how bonds are used in real life. And don't worry, this actually does sound complex, but we will move step by step with examples and in plain language. And that's what I'm trying to achieve here. I will try to make it as simple as possible so that you do not get confused. So let's start. So let's start with the bond pricing. So when we talk about bond pricing, so bond pricing is actually the process of determining the present value of the future cash flows. It's the basic definition of bond pricing. The future, the present value of future cash flows. Present values. CF1, cash flow 1, cash flow 2, cash flow 3, cash flow 4. And I am saying, I am assuming previously we discussed about a problem where there were five, the bond was for 5 years. So I'm assuming 5 years, five cash flows. And at the end of the cash flow, you will also get the face value. So this is, I'm determining the present value of the future cash flows. And now let's break the sentence. So bond gives you two types of future cash flows. One is coupon. Cash flow one is coupon. Coupon one, coupon two, three, four, and five coupons. And the principal, which is the face value. Principal. The face value is repaid at the maturity. So bond pricing answers one question: how much should I pay today for the money? How much should I pay today here in this in this here I am standing today. So how much should I pay? to- So this is what we are trying to answer here. And the core idea of bond pricing is that the core idea is also very simple. The bond's price is the discounted value of all the future payments. So how much should I pay? So we are going to discount it. Uh, Let me just see if there is any other color that I can use. Let's use gray. Okay. So discounted, the discounted value of the future payments. So I'm going to discount these payments here. These I'm going to bring these payments here, discount them to future. Basically, and what I'm going to do is in the last payment, I am also going to factor in the principal payment. So uh, let's do one thing. Let's make a different arrow for this. Now understand this thing. This formula is, it does look complex, but it's very simple formula. We will discuss about the formula in a while, in just a moment. So let's talk about this image first. This line diagram. This represents the time value of money. So I have made us. So I have tried to explain it through uh, image here. So future money is worth less than today, and so we discount the future payments to today. And for that, this formula represents the same thing. This is summation of time starts from n, t is equals to 1, and coupon C represents the coupon payment, and 1 plus y means this is the yield, which is the rate. This yield represents the rate, and this is the number of periods, and n is the number of periods. Now understand this thing, that t means first coupon. The T means first coupon, second coupon, third coupon, fourth coupon, and fifth coupon. The number of years n represents the future value. So we are going to discount it. So let's assume that the rate, the yield is 10%. So we are going to discount everything back here and we are going to add everything up. So that's basically the concept here. I'm assuming that it's 10%. So what I'm going to do is I'm going to put in uh, the principal payment, the future value. I'm going to divide it by 1 plus 10%, and I'm going to discount it by 5 years. So this is how I get my principal back to the present value. 5 years uh, principal for the future, the present value of the principal, and similarly I'm going to discount coupon 1, cash flow 1 by 1 plus 10%. Then I'm going to add cash flow 2, and I'm going to discount it by 2. The time is going to be 2 by 2 years. Then I'm going to discount my cash flow 3 by 3 years. I'm going to discount my cash flow 4 by 10. It's 10%, 4 years. And I'm going to discount my cash flow 5 by uh, 10%, 5 years. And I hope you have understood that. And one thing I would like to reiterate here, I will like to highlight here, is that I can use, if I want to make it simpler, what I can do is I can include my principal payment also along with my cash flow 5 plus principal payment, which is okay, principal payment face value, and I can divide it by 1.10%, 1 plus 10% to the power 5. So basically, I'm clubbing this with this. I hope you have understood the bond pricing formula. So you have to discount everything back to the present value, and I hope this is clear. So the bond pricing formula, we have discussed about this, and if there is still any confusion, you can always post in it in the comments section, and I will be happy to answer that. So before the formula, let's understand the logic here also. So let's talk about it one more time. So you received $100 every year as an interest and $1,000 at the end of the period. So let's assume that you are receiving 100 rupees as an EMI. So let's assume that the coupon payment is 100 rupees, and you are receiving future face value at 1,000 rupees for 5 years. Now understand this thing that still again, the value of 1 year of interest today is going to be, you're going to discount it by the percentage of the yield. This represents rate. Yield represents actually rate. And the year two, we are going to discount it by the, again, but for 2 years. Same similarly for 3 years, similarly for 4 years, and similarly for 5 years. And at the end, we actually have to discount this to the present value also. And this is how actually the formula, this is what actually the formula is representing here. So rather than just mugging up the formula, I have given you the whole concept, how the dynamics of bond pricing. How the bond price of the bond is determined. And see, the understanding the basics is very important, because when you will be working on a real life problem, or in the further in the complex problems, so if you do not understand the basics, that's going to be difficult for you to understand how that the yes, okay, you can use artificial intelligence, you can chat GPT, use Gemini, or any platform of your preference to answer your questions, but do you understand the basics? Because if you do not understand the basics, you would not understand what you're looking for. And you can use all the AI, that's not an issue. You can ask questions, but you need to develop a habit of reading things. Unless until you do that, AI is not going to help you. So if you are asking particular questions, you are looking in one direction only. Maybe you need to look in different directions also to for better understanding. So always try to think in different directions first. And then what direction are you choosing? So that's why it's it's I mean, that's why intelligent people ask intelligent questions. Okay. So it's important. So it's okay. One thing that I would like to emphasize here is that it's important that you do not need to calculate this formula manually in real life. And what you need to do is understand the logic behind it. So never calculate the formula, never just mug up the formula. And if you are mugging up the formula, then this whole episode is actually is a waste of time of yours and mine also. So don't mug up things, just try to understand the logic behind those things. So bond prices, now talk about bond prices versus yield, which is a critical concept. And for beginners, it's going to be difficult. But if you have experience in bond pricing, or if you have worked in the fixed income domain, or if you're from commerce background, then you would be able to relate it. And if you're not from the commerce background, but still you have heard about these numbers, these names, so uh, you will be able to, I mean, you will be a little curious, I hope. Um, if you get a little curious, then you will start digging up things, and I hope that you will find your answers. Okay, so let's get back to the topic here. So now comes the most important idea in bonds. So if you understand this, you understand bonds. When we talk about the bond prices and the yield, so yield and bond prices actually move in different directions. So when yield rises, when the yield of a bond rises, the price of the bond falls. When the yield rises, the price of the bond will fall. And vice versa, when the yield falls, the price of the bond will rise. Why? Because if you remember the formula, how what we did is we discounted it using. Let me use just a simple problem. We discounted cash flow by, let's assume, 1.1%. 1.1. But if we are going to discount something by, let's assume, 1.5, that's going to be a smaller number because this is the numerator and this is the denominator. This is a simple mathematical formula. This is denominator and this is numerator. And I'm trying to deliver this lecture as simple as simple as language as possible, uh, as simple as I can make it. So if you divide this is basic maths. So is yield actually represents the rate, and price actually comes in the price is represented by EMI, the cash flows. Price actually represents cash flows, EMIs in simpler terms for understanding, and the principal value, which is also the face value. So if I'm writing FV, don't get confused. This is not future value, but the face value. And yes, future value. Also, you can say future value. But the better approach would be, the correct word would be face value. Why does this happen? And I have explained to you why the price, even the yield rises and the why the yield rises, so the price, when the yield rises, the price fall, and when the yield falls, the price rises. This is uh, because of simple mathematics, the numerator and the relation between these two. So old bonds and the new bonds. One example also, there is one example also which comes to me, which is actually I'm able to think of. So think about it like this: that you actually have a bond of 8%, and somebody in the market suddenly started to pay a 10. They actually have introduced a bond, and the market says it's paying 10%, and you have a bond which is 8%. So if you think from this here, I'm only talking about one bond. This all these characters. But if you think about bond one and bond two, when you're talking about one bond is giving you 8% return yield and another bond is giving you 10% yield, so the price of your bond must fall to compensate with the buyer here, this bond. And that's why higher yield, this will be discounted at a higher price. So the cash, the current value or the present value, current or the present value will be lower here. And as compared to this, because if a bond is being traded at a lower yield, this means that actually the financials are good. From the credit perspective, they are rated highly. Those are actually investment grade bonds, and these are the characteristics of an investment grade bond. If I'm comparing it, let's uh, not so it could be 8%, maybe below that. That's the below the lower it is, the it's better of an investment grade bond. But the higher the bond's price is, there is higher risk involved in that bond. So understand this though. Okay. I hope we have established something here, something of value here. Uh, okay. So now understand this thing. What is premium, what is par, and what is discount? In mathematical terms, in simple bond, when we talk about bond in finance, if the yield is high, par, premium, discount. Okay, let's do one thing. Let's make it in the sequence. It's this one is premium, this one is par. So par, when we talk about the bond which is being discounted at which is being traded at par, this means that the face value is the face value. Let's assume that the face value is 1,000, but for a par bond which is being traded at the par value, this means that the coupon is equal to the yield. When we talk about a premium bond, this means the bond is being traded below its face value. So this means the price of the bond is actually greater than the face value. This means the coupon price is greater than the yield. And when we talk about the discount bond, this means just opposite to premium. The bond is being traded at lesser than. This means that the okay, I made it. So the price of the bond here is less than the face value. You have understood the face value concept here, and this means that the yield is high, and coupon is low. Now understand this thing. Par bond, a bond which is being traded at par means that the price will be equal to face value. And the face value is 1,000, and here the coupon is 10%. Let's assume the coupon is 10% and the yield is 10%. Or let's not complicate this thing. Let's understand this thing in a very simple way. So understand this. We are talking about a premium bond, par, and a discount. I am assuming that the coupon payment are $10, for 2 years, and the face value is 1,000. We have these numbers. This is the coupon and this is the face. Now, this everything changes because of the yield here. If the yield is 10, if the yield is equals to 10%, which is in the case of a par bond, so this is we are going to discount it by 10. This again we are going to discount by 10. But when we talk about a bond where the discount yield is lower than the coupon, so I am going to discount this by a lower number. This means the the value is going to be higher here. The price is going to be higher. That's why the price is high here. Simple mathematics. Just understand this from the perspective of a numerator and denominator. So numerator we are not changing, but when we are changing the denominator, the when we decrease the denominator, the value increases. When you increase the denominator, the value decreases. The overall value, the overall ratio decreases actually, not just the numerator. The numerator is going to be stay constant. But when we decrease the denominator, the numerator, the value of the this whole ratio actually increases. When we increase the denominator, this whole ratio decreases actually, and that's what actually represents. That's what actually shows the relationship between premium par, and the discount bonds. And mm, since we have discussed this thing, let's understand what are the yield. What does yield means? So yield is actually the measure of return by a bond issuer. So interest rates are equal are in the bonds. There are different terms used. So interest rates represent yield, and yield measures the return by the bond investor, and it tells you how much you actually earn based on price, coupon, and time. So that's how uh, investors calculate. And this word is actually specific to fixed income yield. Okay, so let's this is now actually going to be complicated. This is actually important, but this would be complicated for somebody who's not from finance background. So there are different type of bond yields. So one is a coupon yield, and another is a current yield, then yield to maturity, yield to call. There are different type of yields when we talk about the performance of a bond. So let's not dig deep into that. Just understand the overall concept. So coupon yield, when here we are only talking about coupons. So annual coupon divided by the face value, that's 10 by 1,000. In our previous case, that would be the coupon yield. When we talk about the current yield, that would be annual coupon and the market value. Whether it's being traded at a discount, that's now it's going to be influenced by the uh, current value, not the current value, premium, par, and discount. Premium, par, and discount. So every time the ratio will vary. So just I'm just doing it for year one. Yield to maturity represents, then this is important, and now understand this thing. Yield to maturity is the total return earned if you hold the bond till maturity. That's what maturity, it says maturity in the uh, yield itself. So yield to maturity is if you are holding this for 5 years, how much return have you earned overall for the 5 years? That's yield to maturity. And yield to maturity is actually also the IRR of the bond. Okay, so yield to maturity of a bond is 10%, let's assume, and yield to maturity is 10%. And if you remember previously, we talked about the coupon payments going up and down. Here. So coupon payments are actually going up and down. So floating rate bonds. So in these kind of cases, step up, step down. In these kind of cases, the ETM, YTM also changes because the coupon payment changes. And in those kind of cases, here, in those kind of cases, you actually have to calculate an internal rate of return. This is internal rate of return actually represents the minimum return that you should get. In when we talk, if you remember when we talked about equities, that was risk-free rate, and then we factor in other factors, time, premium for time, liquidity premium, the default risk premium, and all those things to how to calculate those the interest rate for equity securities. And when we talk about the uh, bonds, in IRR is actually is the minimum return that you actually require if your security, if after everything, if you were able to generate 15% of return in that specific bond, so your spread is going to be 5%. But IRR means, I hope you have established the basic definition of what IRR represents. And simply, YTM tells you what your annual return will be if everything goes as planned. And that is why YTM is the most widely used yield measure. Okay, so let's move to the next type of yield, which is actually the yield to call. And some bonds allow the issuer to repay early. So calling means they actually are calling. Uh, if the bond has a call option, this talks about an option. So the, if a bond actually has a call option, the company may repay before maturity, and in that case, the yield to call is calculated rather than yield to maturity. So understand this thing. So yield to call, and there are factors at which the company calls a bond back. So call option is actually a right but not an obligation. We talked about this in our in some previous lectures on some previous episodes, I think. So it's a right. So you actually have a right, but you do not have an obligation. There is a difference. Understand this thing. So just be specific. I just want to be clear about it. So it's a right to buy, right, but not an obligation. I do not have any obligation. I actually have a right. I can let the option expire. So if the company has previously raised debt at 10%, and now because of the market conditions, the company can raise debt at 8%, what they are going to do is they are going to actually call back all those bonds and pay the investors and uh, now raise new debt at a lower price. That's how, when you are into fixed income security, you actually have to constantly track the economy. You actually have to constantly track the markets, the interest rates. Okay, so then we come to. I hope this much was clear, and this is like the fixed income securities are very interesting. For me, those are very interesting. This actually is a very interesting topic, and okay. So bond duration and the interest rate risk. Um, so duration measures how sensitive a bond is to the price. Sensitive a bond's price is to its the interest rate changes. In simple words, how much the bond price will move when the interest rate changes. So this thing, and everything depends on. The everything depends on this formula. How sensitive the bond is to its interest rate changes. Do- And the key rules to follow here is that longer maturity means higher duration and lower coupon rate means higher duration. Longer maturity means higher duration, lower coupon rate means higher duration means higher risk, and long-term bonds are more sensitive to rate changes because this kind of situation can happen, what we just discussed. Modified duration is for a beginner, it's way too much, but modified duration gives us a shortcut formula here. So change in price means duration and the change in yield. This is actually representing yield. Why was always representing yield, guys? Don't get confused. So I hope this is clear. And okay, so there are risk in bond, yes. There are call options. I mean, okay, risk in bonds are there are credit risk, issuer may default. There is interest rate risk, rate change before bond prices. Inflation risk is there. Purchasing power erosion, liquidity risk, hard selling. It's hard to sell. Nobody, if somebody is selling a bond of a company which has actually recently defaulted, or uh, any company at this time which is not doing well, so any company which is being taken over by another company, so it's very hard to sell those kind of bonds. Reinvestment in coupon investment at lower rate, call risk, issuers pay early, so these kind of factors uh, actually these are the risks which are actually involved with the bond with the bonds. So, and when we talk about bond structures and features, common features are call option, put option, convertible features, covenants. Covenants is just a fancy term for rules and regulations when we talk about bonds. In fixed income securities, yes, there are certain rules and regulations. So when you are raising debt from the borrower, actually embeds them in the contract, so you do not breach the contract. If you breach the contract, if you breach the contract, I mean, everything gets void. And okay, so the big picture here is that the bonds are the foundation of the fixed income market, and they actually offer predictable cash flows and cash preservation while exposing investors to interest rates, credit risk, and inflation risk. Thank you for attending today's session. Let's wrap it up, and I'll see you in next session. Thank you.